China has introduced a new K-visa program aimed at attracting foreign tech talent, positioning itself as a more open alternative amid the U.S.'s increasing visa restrictions. The K-visa, which launches this week, targets young STEM graduates and allows entry and employment in China without the need for a job offer. A significant departure from the U.S. H-1B visa system that requires employer sponsorship and is subject to a lottery. This move comes as the U.S. has announced a substantial $100,000 annual fee for H-1B visas, potentially deterring new applicants. By contrast, China's approach is seen as a strategic move to enhance its attractiveness to global tech talent. Amidst ongoing geopolitical tensions with the U.S., the K-visa reflects China's broader efforts to boost foreign investment and talent acquisition, as the country faces economic challenges from U.S. tariffs and trade tensions. While the visa offers a streamlined process compared to the U.S., it comes with its own set of challenges, including vague eligibility criteria, language barriers, and limited pathways to permanent residency or citizenship. Despite these hurdles, the K-visa could appeal to Indian STEM professionals and others seeking alternatives to the U.S., potentially enhancing China's competitiveness in cutting-edge technology sectors. However, analysts note that China's recruitment efforts remain modest compared to its initiatives to repatriate Chinese STEM talent from abroad.
During the second quarter, Visa Inc. (NYSE) experienced slight reductions in stock holdings by institutional investors Old Port Advisors and 1+1 Wealth Management LLC, who decreased their positions by 2.1% and 3.2%, respectively. Despite these minor divestments, Visa continues to be a favored choice among institutional investors, with major entities like Vanguard Group, Northern Trust Corp., and UBS Asset Management increasing their stakes earlier this year, underscoring confidence in Visa's strong market performance. Visa, a leading credit card processor, reported a robust quarterly performance with a 14.3% year-over-year revenue increase to $10.17 billion and earnings per share of $2.98, surpassing expectations of $2.85. The company's effective cost management and strategic initiatives, such as expanding VisaNet and enhancing digital payment solutions, contribute to its strong market position, reflected in its net margin of 52.16% and return on equity of 58.93%. Analysts remain optimistic about Visa's future, with Morgan Stanley and Barclays raising their price targets to $402 and $408, respectively, and maintaining an overweight rating. Visa's stock, with a market cap of $617.93 billion and trading around $337.15, is regarded as a stable investment in the payment technology sector. The company's recent dividend announcement, with a yield of 0.7%, adds to its appeal for income-focused investors. Overall, Visa's strong financial metrics and strategic positioning suggest a positive long-term outlook, despite minor fluctuations in institutional holdings.
Patton Fund Management, Inc. has acquired 3,754 shares of Monster Beverage Corporation, NASDAQ, MNST, during the second quarter, as revealed in its latest 13F filing with the SEC. This acquisition, valued at approximately $235,000, is part of a broader trend where various hedge funds and institutional investors are adjusting their stakes in Monster Beverage. The company, known for its energy drink brands, has seen a significant institutional ownership, with 72.36% of its stock held by such entities. Notably, Monster Beverage shares opened at $65.34 on Monday, reflecting a 1.2% increase, with the stock trading near its 12-month high of $67.13. Monster Beverage's recent financial performance has been robust, with its latest quarterly earnings surpassing analyst expectations. The company reported earnings per share (EPS) of 52 cents, exceeding the consensus estimate of 48 cents, alongside a revenue of $2.11 billion, up 11.1% year-over-year. The firm has demonstrated strong profitability metrics, including a net margin of 20.54% and a return on equity of 27.46%. Analysts remain divided on the stock, with a mix of buy and hold ratings and an average target price of $65.19. Citigroup and Bank of America have issued buy ratings, raising their price targets to $76 and $72, respectively, indicating a positive outlook on the company's growth prospects.
Kathmere Capital Management LLC recently reduced its stake in the iShares Semiconductor ETF, NASDAQ, SOXX, by 4.5% during the second quarter. As per its latest SEC filing, the firm sold 56 shares, bringing its total holdings to 1,180 shares valued at approximately $282,000. This move comes amidst a broader trend where various institutional investors have been adjusting their positions in the ETF. Notably, BNP Paribas Financial Markets significantly increased its holdings by 220.2% in the first quarter, now owning 968,262 shares worth $182.2 million. Other institutions such as LPL Financial LLC, Overseas Chinese Banking Corp. Limited, and Raymond James Financial Inc. have also increased their stakes, indicating a diverse range of investment strategies among institutional players. The iShares Semiconductor ETF, which aims to track the performance of U.S.-listed semiconductor stocks via the PHLX Semiconductor Sector Index, has seen its stock price increase by 0.2%, opening at $268.83. The ETF has experienced substantial growth, with its price reaching a 52-week high of $272.13, reflecting strong performance in the semiconductor sector. The ETF's market cap stands at $14.87 billion, with a price-to-earnings ratio of 31.84 and a beta of 1.34, indicating higher volatility compared to the broader market. Additionally, the ETF has increased its quarterly dividend to $0.5407, offering an annualized yield of 0.8%, which may appeal to income-focused investors. These developments underscore the dynamic nature of the semiconductor industry and its influence on investment strategies.
Baker Hughes Company, NASDAQ BKR, has seen a notable investment from Patton Fund Management, Inc., which acquired a new position valued at approximately $232,000 during the second quarter. This move is part of a broader trend, with various institutional investors and hedge funds adjusting their holdings in the company. Currently, institutional investors own 92.06% of Baker Hughes stock, reflecting strong institutional confidence. The company's stock is trading at $50.52, close to its 12-month high, and has shown an upward trend with a 0.8% increase recently. Baker Hughes has a market capitalization of $49.81 billion and a price-to-earnings ratio of 16.51, indicating a relatively stable financial position. In terms of analyst sentiment, Baker Hughes maintains a moderate buy consensus rating, with a significant number of analysts recommending a buy on the stock. Recent price target adjustments by firms like Susquehanna and TD Cowen have set higher expectations, with targets reaching up to $54. This optimism is underpinned by the company's strong quarterly performance, reporting earnings per share of 63 cents, surpassing the consensus estimate. Despite a slight decline in quarterly revenue compared to the previous year, Baker Hughes continues to demonstrate robust financial health, with a return on equity of 14.56% and a net margin of 11.04%. Insider trading activities have also been reported, with significant sales from key executives, including CEO Lorenzo Simonelli. These transactions, although reducing insider ownership, have not dampened market confidence, as evidenced by the stock's positive performance and analyst outlook. Furthermore, Baker Hughes continues to reward shareholders with a stable dividend, offering a yield of 1.8% based on its current payout ratio. The company's strategic focus on its oilfield services and equipment and industrial and energy technology segments positions it well to capitalize on ongoing developments in the energy and industrial sectors.
Patton Fund Management Inc. has initiated a new investment in MSCI Inc., acquiring 410 shares valued at approximately $236,000 during the second quarter. This move is part of a broader trend among institutional investors, with major players like Vanguard Group and AQR Capital Management significantly increasing their holdings in MSCI. The technology company, known for providing critical decision support tools and financial indexes, has seen a notable increase in institutional ownership, with 89.97% of its stock held by such investors. MSCI's stock performance has been under the spotlight, with Wall Street analysts maintaining a generally positive outlook. The stock opened at $565.40 recently, with a consensus rating of moderate buy and an average target price of $652.45. This optimism is supported by MSCI's recent financial results, which exceeded expectations. The company reported a Q2 earnings per share of $4.17, surpassing the consensus estimate, and a revenue increase of 9.1% year-over-year. Despite some fluctuations in price objectives from firms like Wells Fargo and UBS, the overall sentiment remains bullish, reflecting confidence in MSCI's strategic direction and market position.
Globe Life Inc. (NYSEGL) has seen increased interest from institutional investors as Kathmere Capital Management LLC boosted its stake in the company by 5.6% during the second quarter of 2025. The firm now owns 2,195 shares valued at $273,000. According to SEC filings, this move is part of a broader trend with several other institutional investors, such as TD Private Client Wealth LLC and Public Employees Retirement System of Ohio, also increasing their holdings in Globe Life. Institutional ownership now stands at 81.61%, indicating strong confidence in the company's prospects among large investors. Globe Life's recent financial performance has been solid, with the company reporting earnings per share, EPS, of $3.27 for the latest quarter, slightly above analysts' expectations. The company's stock has been performing well, with a 52-week high of $147.83 and a current market capitalization of $11.70 billion. Analysts have shown optimism, with firms like Wells Fargo and J.P. Morgan Chase raising their price targets and maintaining overweight ratings. Globe Life is also maintaining a modest dividend yield of 0.7%, with a dividend payout ratio of 8.63%, reflecting its stable financial health. The company's focus on life and supplemental health insurance products continues to position it well in the market, catering primarily to lower middle and middle-income families in the U.S.
During the second quarter, both Patton Fund Management Inc. and TD Private Client Wealth LLC made notable investments in Old Dominion Freight Line Inc., NASDAQ, ODFL, a key player in the less-than-truckload (LTL) transportation sector in North America. Patton Fund Management Inc. initiated a new position with the acquisition of 1,501 shares valued at approximately $244,000, while TD Private Client Wealth LLC significantly increased its stake by 210.7%, acquiring an additional 1,302 shares to bring its total holdings to 1,920 shares, valued at around $312,000. These investments reflect a broader trend of institutional investors adjusting their positions, indicating ongoing interest and confidence in the company's strategic importance within the transportation industry. Despite the institutional interest, Old Dominion Freight Line's stock performance has been mixed. The stock opened at $138.59, reflecting a 1.3% decrease. In its recent earnings report, the company reported quarterly revenue of $1.41 billion, a 6.1% decline from the previous year, and earnings per share, EPS, of $1.27, slightly missing the consensus estimate of $1.29. Analysts have given the stock a consensus rating of hold, with a price target of $166.95, reflecting cautious optimism about the company's ability to navigate current market conditions and maintain profitability. The firm, however, continues to demonstrate strong operational efficiency with a robust net margin and return on equity. The strategic moves by institutional investors and the mixed analyst outlook underscore the dynamic environment in which Old Dominion Freight Line operates. With a market capitalization of $29.13 billion, the company remains a significant player in the logistics sector. Investors are closely monitoring the company's performance and strategic direction amidst broader economic uncertainties and sector-specific challenges.
Patton Fund Management Inc. has recently invested $234,000 in Apollo Global Management Inc., NYSE, APO, as disclosed in their latest 13F filing with the SEC. This acquisition of 1,651 shares underscores a broader trend among institutional investors increasing their stakes in Apollo, a private equity and financial services provider. Notably, Apollo's stock has seen a positive trajectory, with shares opening at $137.65, reflecting a 1.1% increase. The company maintains a market capitalization of $78.74 billion and a price-to-earnings (PE) ratio of 25.73, indicating investor confidence in its growth potential. Apollo Global Management's recent financial performance has been robust, with the company reporting earnings per share (EPS) of $1.92 for the last quarter, surpassing analysts' expectations. The company's revenue stood at $6.55 billion, significantly higher than the anticipated $1.01 billion, driven by its diversified investment strategies across credit, private equity, and real estate markets. Analysts have a favorable outlook on Apollo, with a consensus rating of moderate buy and an average price target of $166.27, reflecting optimism about the firm's strategic positioning and growth prospects. The company's dividend yield of 1.5% and recent insider trading activities, including significant stock sales by key executives, add layers of interest and scrutiny from investors monitoring insider confidence and market dynamics.
Edison International, NYSE, a prominent utilities provider, has seen a notable increase in institutional investment activity, highlighted by Patton Fund Management, Inc.'s recent acquisition of a $235,000 stake. This move is part of a broader trend where major institutional investors like Vanguard Group, Invesco Limited, and J.P. Morgan Chase & Company have significantly increased their holdings in Edison International over recent quarters. These investments reflect growing confidence in the company's performance, underscored by its strong quarterly earnings report, which surpassed analysts' expectations with an EPS of 97 cents and revenue of $4.54 billion. Edison International's stock has experienced a modest growth trajectory, opening at $55 with a market capitalization of $21.17 billion. The company's financial health appears stable with a debt-to-equity ratio of 2.03 and a current dividend yield of 6.0%. Despite a mixed outlook from analysts, with ratings ranging from buy to underweight, the consensus remains hold, with an average target price of $71.75. The company's strategic guidance for FY 2025, set between 5.940 to 6.340 EPS, suggests a positive long-term outlook, potentially bolstering investor confidence in the utilities sector amidst economic uncertainties.